All right, let's jump right into this explainer. Today, we're uncovering a massive two-front war that's currently targeting your retirement savings. Look, if you're a retail investor just trying to build a secure nest egg for the future, you need to pay very close attention to what the data is showing us today. We're essentially looking at a classic pincer movement. From the bottom, the macroeconomy is squeezing your wallet every single day. And from the top, structural market changes are quietly weaponizing your safe, passive investments.
So, here is our roadmap for today. 1. The 2026 economic squeeze. 2. The passive investing trap. 3. Deconstructing SpaceX. 4. Rigging the NASDAQ rules. And 5. Protecting your retirement.
Okay, Section 1. The 2026 economic squeeze, the illusion of the raise.
To truly understand the threat to your retirement accounts, we actually have to take a step back and look at your daily budget. So let me ask you a really serious question. Did you get a raise this year? Maybe you switched jobs or you negotiated hard and your salary is genuinely the highest it's ever been. But if that's the case, why is your bank account practically screaming at the end of every single month? Well, you're not imagining things, and you certainly aren't bad at math. The numbers completely validate what you're feeling right now. Think about the math here. On paper, average nominal wages in the US have risen roughly 18 to 20% since 2020. I mean, that sounds fantastic, right? But in reality, inflation has eaten up roughly 23 to 25% of your real purchasing power. This is a real wage decline in action. So the illusion is that you are earning more total dollars, but thanks to inflation, those dollars literally buy significantly less real-world stuff than they did just 5 years ago.
And what's really concerning is exactly where that money is going. We're not talking about luxury expenses you can just, cut with some budgeting app. These are the big three non-discretionary spikes. Rent and housing, up over 30% since 2022. Groceries, food at home cost 21% more than it did in 2021. And health insurance premiums for the average family just crossed a staggering $25,000 last year. These are completely unavoidable categories, and they're absolutely devouring the cash you used to systematically save for retirement.
Section 2. The passive investing trap. Wall Street's Trojan horse.
So when inflation shrinks your disposable income, what's the standard sensible financial advice? It's to invest your way out of the hole through passive 401ks and broad index funds, right? But right now, that exact automated system is being turned against you. Just let this staggering number sink in for a second. $1.75 trillion. This is the reported target valuation for the upcoming SpaceX IPO. To put that into perspective for you, at that valuation, SpaceX will be worth more than the top 10 companies on the London Stock Exchange combined. It's just a mammoth figure.
Section 3. Deconstructing the SpaceX IPO. The good, the bad, and the ugly. Okay, to see exactly why this massive IPO directly threatens your passive retirement investments, we really have to look under the hood. SpaceX actually comprises a few very different business units, so let's break down the revenue. Starlink is absolutely the crown jewel here. It brought in $11.4 billion, and it's a total cash-printing juggernaut with profit margins that recently accelerated to 63%. Then, of course, you have the rocket business, bringing in a solid $4 billion. Both of those are highly functioning businesses, but together they only tell half the story of what your retail index funds are about to buy. Because here's the catch. Earlier this year, SpaceX acquired an AI lab called xAI in an all-stock deal that valued xAI at $250 billion. Now, as noted in the reporting, this dynamic is sometimes referred to as the reverse Jerome Powell effect. Why? Because instead of generating revenue, it acts as an incredible cash furnace. By March of 2025, xAI had actually lost all 11 of its original co-founders and was burning through roughly $1 billion a month. Because of this single acquisition, the consolidated SpaceX entity actually lost nearly $5 billion last year, entirely wiping out those massive Starlink revenues.
Section 4. Rigging the NASDAQ rules. Engineering exit liquidity. If you're sitting there as a retail investor wondering who on earth is going to buy an unprofitable company at a record-shattering $1.75 trillion valuation, well, the answer is your retirement account. And it's all thanks to brand new rules that were quietly passed on May 1st. Let's break down how this trap works. Under the old rules, companies had a 3-month wait time before joining the NASDAQ 100 just to allow the market to discover their true price. The new fast entry rule cuts that down to just 15 days. They completely removed the requirement that a minimum of 10% of shares be publicly available, and honestly, most shockingly, they added a hidden multiplier. If a company only floats 4 to 5% of its shares, which by the way is exactly what SpaceX is targeting, ETFs are forced to weigh it as if it were 3 times larger. This essentially manufactures massive automatic demand from index funds out of thin air. And who exactly is on the other side of this trade? Well, the SpaceX CFO recently stated, retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that. Now, most IPOs allocate maybe 5 to 10% of their shares to retail buyers, but SpaceX, they're planning to allocate a massive 30%. While it's framed as a reward for support, in pure financial mechanics, this translates to dumping nearly a third of the supply directly onto everyday workers and retail buyers.
Which brings us to a crucial term that absolutely every retail investor needs to know: exit liquidity. This happens when early insiders and venture capitalists use the forced automatic purchasing power of your retirement accounts to basically cash out their shares at peak engineered valuations. What this means is that the very feature that makes passive index funds so convenient and hands-off for you is exactly what guarantees Wall Street a captive buyer for an overvalued mega IPO.
Portfolio manager George Noble summed it up perfectly when he said, "Your 401k is the exit liquidity." Because of those NASDAQ rule changes we just talked about, within just 3 weeks of the SpaceX IPO, the mechanical automated rules of passive investing will forcefully buy SpaceX shares using your retirement money. You won't have a vote, you won't have a choice in the matter. The system will just automatically buy it for you at that $1.75 trillion valuation.
Section 5. Protecting your retirement savings, your 2026 financial defense plan.
So how do you actually fight back against this two-front war? With inflation crushing your daily budget from the bottom and market manipulation skimming your savings from the top? Well, here are 4 actionable steps. Number 1, stop wasting your energy optimizing $15 streaming services. Target your big expenses. Housing is where your leverage actually is. Number 2, attack high-interest debt like it's a second job. Credit cards are sitting at 20 to 26% APR right now. Destroying that balance is literally the best guaranteed return you can get. Number 3, strategically upskill in high-demand fields like tech, trades, or healthcare over the next 6 to 18 months to boost your income. And number 4, keep investing. Absolutely make sure you are capturing the free money via your employer's 401k match. Actually, I want to be super clear on this next point. Despite those engineered NASDAQ rules we just uncovered, you should still keep investing consistently in broad, low-cost index funds. Over a 10-year horizon, staying the course in the broad market will still serve you vastly better than panicking, pulling your money out, or trying to chase complicated social media stock-picking strategies. You just need to do it with a confident, clear-eyed understanding of the mechanics at play. If you want to protect your hard-earned money from this system, it's just absolutely crucial to stay informed and vigilant. So I want to leave you with this provocative question to really think about. Your 401k is being mechanically weaponized to automatically buy newly engineered IPOs. So, are you truly managing your retirement, or are you letting the system manage it for you? Keep learning, stay focused, and I'll see you in the next explainer.